Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for this subject, Principles and Practices of Accounting. In this lecture, we'll continue with Accounting Chapter 5, that is Concept and Accounting of Depreciation. All the concepts will be covered in the coming series of lectures. So let us begin. This is lecture number 5. We'll begin with an illustration. So write an illustration in relation to SLM method of depreciation. An illustration. Write a a transport company, a transport company purchases 5 trucks, 5 trucks at rupee 2 lakhs each on 1st July 2015. The company the company writes off depreciation the company writes off depreciation at the rate 20% per annum on original cost. That means this is the original cost method, that is straight line value method. On January 1st 2018, on January 1st 2018, one of the trucks is involved in an accident and is completely and is completely destroyed completely destroyed. Insurance company pays rupee 90,000 rupee 90,000 in full settlement of the claim full settlement of the claim full settlement of the claim on the same day on the same day on the same day the company purchases a a used truck for rupee 1 lakh for rupee 1 lakh and spends rupee 20,000 on its overhauling. We need to prepare prepare truck account for 3 years for the 3 years for the 3 years ending on 31st March 2017. Just try to understand the question once again. A transport company purchases 5 trucks at 2 lakh each. So 2 lakh multiplied by 5 leads to 10 lakh on 1st July 2015. The company writes off the depreciation at the rate 20% on original cost method, that is SLM. On January 18, one of the trucks is involved in an accident and completely destroyed. Insurance company paid 90,000, so there would be some loss we need to calculate. In full settlement, on that day, the company purchases a used truck the same day, that is on January 1st, 2018, for 1 lakh and spends 20,000 on its overhauling. So this 1 lakh plus 20,000 leads to 1 lakh 20,000. 1,20,000, because this 20,000 needs to be capitalized. This 20,000 needs to be capitalized in the value of the machinery. We need to prepare what? Prepare a truck account for 3 years ending 31st March 2017. I believe you understood. Let us make truck account now. Let us try and make truck account now. Solution. Solution. Before making truck account, we'll make working note. Working note. Notes. First working note, book value of one truck that is destroyed, one truck on date of accident. So we had purchased the truck for 2 lakhs minus depreciation at the rate 20% for 30 months. So 2 lakhs, 20%, 30 by 12. How come this 30? From 1st July 2015 to 1st January 2018. It's 30 months. From this date to this date, the duration is 30 months. I believe you understood. Let us move ahead. So July, for over here, 2 lakh minus depreciation for 30 months. So this is 2 lakh minus 1 lakh equal to 1 lakh. Now the value of the book value of the machinery is, the book value is 1 lakh, but actually the insurance company settled the claim for 10,000. So just write insurance company paid in full settlement. In full settlement, what they paid is 90,000. So loss on date of accident, loss on date of accident equal to 1 lakh minus 90,000 that we have received, 10,000. 10,000 is the amount of loss. 10,000 is the amount of loss. I believe you understood that the loss is 10,000 if our truck met an accident. Now let us try to make truck account. Let us make truck account now. On a fresh page, make a truck account. Truck account. Truck account. Truck account. Just draw the format. Date, particulars, amount. Date, particulars, amount, debit, credit. Date, particulars, amount, date, particulars, amount. Write the date on 1st July 2015. 5 trucks was purchased for 2 lakhs each to 2 bank account. 2 lakh multiplied by 5 trucks, so it is 10 lakhs. It is 10 lakhs. Now on 31st March 2016, we need to calculate the depreciation for 9 months from this date to this date, 9 months. So by depreciation 10 lakhs 10 lakhs 20% is the rate of depreciation that has been given in the question, and we need to calculate for 9 months. So 10 lakhs multiplied by 20 by 100 multiplied by 9 by 12, it is 1,50,000. It is 1,50,000. So total over here is 10 lakhs. Total over here is 10 lakhs and 1.5 lakhs. So this is 8.5 lakhs. 8,50,000. 8,50,000 by balance carried down. By balance carried down 8,50,000. I believe you understood. I believe you understood. क्या लेके अकेला हाथ तक करे ऊपर भाग रहा यहाँ से भी ठंडा नहीं है, गर्म भी नहीं है, मेरे डर से वो गर्म हो गया है। मम्मी अपन दोनों घूमने चलेंगे। पहला तेरा चिजुआना किन बोला तब तेरा मेला देखा के कुछ किन बोला सॉरी सॉरी सॉरी। आज पता नहीं है बार बार जुई जुई करके क्या जा रहा है ये, बहुत सारे जा रहे हैं। 2.5 लोगों में पता नहीं। ये रहा पेन ले लेना, मेरा पेन है। हाँ ये तेरा है ना, मैं बदला नहीं है, मैंने नहीं बदला तो बदल दूं मैं वो ध्यान से रखा था कि कहीं बदल में ना आ जाए। अगर बदला भी गया तो तेरा फायदा ही है ना, बदला गया है इधर का इधर ऐसे तो मैंने 2-3 बार किया कि ये मेरा है ये उसका है मेरा नहीं मैंने बहुत ध्यान से रखा था कि ये लेफ्ट मेरा राइट उसका मेरा। ये देख मैं कौन सा कैलकुलेटर यूज करता हूँ। अच्छा इधर है, इधर इधर इधर, एक कैलकुलेटर दे उठा के। और ये हटा दे, ये उधर, ये हटा दे बस। चलो मेरे को अपना काम करने दे। As you can see, on 1st of January 2018, there is a truck who met an accident. In that case, we need to calculate the book value of this truck over here. And we have calculated the book value was 1 lakh. And basically, the profit or loss also needs to be calculated on this date. So let us first of all calculate the depreciation. Depreciation. So over here, on 1st of January 2018, by depreciation, by depreciation of one machine, one truck. So 2 lakh multiplied by 20% multiplied by 9 by 12 multiplied by 9 by 12. So the opening figure over here is the, basically this is the WDV of all the 5 trucks. Out of this, from 1st of April 2017 to 1st of January 2018, we need to calculate depreciation, and that is for 9 months. So 2 lakh multiplied by 20 by 100 multiplied by 9 by 12 is 30,000. So the depreciation is 30,000, and we have received 90,000 from the insurance company. 90,000 claim we have received from the insurance company. So basically we had a loss of 10,000. We had a loss of 10,000. So by profit and loss account, loss of 10,000. I believe it is clear. This loss of 10,000 is clear. Now we need to also charge depreciation on remaining assets. So on the year end 31st March 2018, we need to charge depreciation. So we will write by depreciation. Now, out of the 5 trucks, 1 truck is destroyed. We have charged the depreciation and accounted for 4 trucks of 2 lakhs each. So, 8 lakhs multiplied by 20%. For the whole year, we need to charge depreciation. So, this would be 8 lakhs multiplied by 20% is 1 lakh 60,000. 1 lakh 60,000. We had also bought a new truck in between. We have also bought a new truck in between. The truck we have bought for 1 lakh and 20,000 we have spent on overhauling. So over here just write in bracket new truck 1 lakh 20,000, because 20,000 needs to be capitalized. 1 lakh 20,000 multiplied by 20%, and it's only 3 months now, so multiplied by 3 by 12. So the depreciation value is 6,000. The depreciation value is 6,000. So over here this is old trucks, and over here this is new truck. Just stretch these lines a bit. So we'll be able to account properly. Stretch these lines. So I believe you must have understood that there are 2 depreciations. The first depreciation is of the old trucks, 8 lakh multiplied by 20 by 100 multiplied by 12 by 12 for the whole year. The depreciation figure is 1 lakh 60,000, and this depreciation is for the new truck, that is 1 lakh 20,000 multiplied by 20% into 3 by 12 for 3 months. The depreciation is 6,000. Now just try to calculate the closing balance. 31st March 2018, just closing balance would be by balance carried down, but we need to total it first. 6 lakh 50,000 plus 1 lakh, 7 lakh 50,000 plus 20,000, 7 lakh 70,000, 7 lakh 70,000, 7 lakh 70,000. I believe this is clear. 7,70,000. Now, what we need to do is old truck, the value for old truck, and just calculate it for new truck separately. So old truck it is, just try and understand, for old truck 6,50,000 was the value. What is the depreciation? 1,60,000. So 6,50,000 minus 1,60,000 is the depreciation. Then what we did is, then the old value is 6,50,000. The depreciated value is 30,000. So 6,50,000 minus 30,000. The value is 6,20,000. Now we need to deduct this 1,90,000 and 10,000. So minus 90,000 minus 10,000 is 5,20,000, minus the new depreciation is 1,60,000, minus the new depreciation 1,60,000. So this closing balance is 3,60,000. This closing balance is 3,60,000. On the same lines, this 1,20,000 over here, minus we need to do depreciation, that is 6,000. 1,20,000 minus 6,000 for new machine, 1,14,000. 1,14,000. I believe it is clear. I believe it is clear. So here we have completed making this truck account, and we have accounted it properly on the basis of straight line value method. In this question, the name original cost was given. So on the basis of original cost method, fixed installment method, or straight line value method, we have accounted this truck properly. Understood? I believe you must be clear till here. Let us move ahead now. Write an illustration. Write an illustration. Now we are going to learn a three machine case where there would be three machines. Few machines will be sold, and accordingly we need to do the accounting. This could be the toughest that could be asked in the exam. So do it very precisely. X Limited, illustration. X Limited has imported a machine. X Limited had imported a machine on 1st October 2015, 1st October 2015 for rupee 1,28,000, paid paid customs duty, paid customs duty and freight rupee 64,000, and incurred erection and incurred erection charges rupee 48,000, erection charges rupee 48,000. Another local machinery another local machinery costing rupee 80,000, was purchased was purchased on 1st April 2016, 1st April 2016. On 1st October 2017, on 1st October 2017, a portion of the imported machinery, a portion of the imported machinery, a portion of the imported machinery value one third, value one third got out of got out of order, got out of order and and was sold for was sold for 27,840. 27,840. I believe you understood this here till here. Another machinery, there was an more machinery, so another machinery was purchased, another machinery was purchased to replace replace the same for rupee 40,000, for rupee 40,000. Depreciation is calculated. Depreciation is calculated. Depreciation is calculated at 20% per annum, at 20% per annum on original cost basis, on original cost basis. Depreciation is calculated on original cost basis. What is required in the question? Prepare machinery account, prepare machinery account, prepare machinery account for the first 3 years, for the first 3 years ending, for the first 3 years ending 31st March 2018, 31st March 2018. I believe you must have understood the question. Just refer it once more. X Limited has imported a machine on 1st October 2015 for 1,28,000 and customs and freight paid, that is 64,000, and erection charges was 48,000. So customs duty and freight paid 64,000 and erection charges of 48,000 would be accumulated in the original cost of machine, and the original cost of machine would be 1,28,000 plus 64,000 plus 48,000. It is to be capitalized. Okay, next. Another local machinery costing 80,000 was purchased on 1st April 2016. One more machinery of 80,000 purchased on 1st April 2016. On 1st October 2017, a portion of the imported machinery, the value is one third, got out of order and was sold for 27,840. Okay, so we'll start with the machinery account now. We'll begin with the machinery account now. Just make machinery account. Machinery account. Machinery account. Okay. Date particulars. Date particulars. Amount. 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 Particulars. Amount. Debit, credit. Debit, credit. On 1st October 2015, the machinery was purchased. So to bank account, this is machine 1. This is machine 1. We have purchased machine 1 for 1,28,000. Now on this, we have incurred certain expenses. First expenses was 64,000. This 64,000 is incurred for freight expenses. one more expense is there, that is of 48,000 erection. 48,000, this is of erection. I believe you understood. Now on the closing date, that is 31st March 2016, depreciation needs to be charged. Depreciation needs to be charged on this. So by depreciation, how we will calculate the depreciation? 2,40,000 multiplied by 20% multiplied by 6 by 12, 110 2015 to 31 3 2016, 6 months that are there. So 24,000 multiplied by 20% multiplied by 6 by 12, this is 24,000. This is 24,000. I believe you understood. Now let's do a total. Let's make a total of it. 1,20,000 plus 1,28,000 plus 64,000 plus 48,000. The total is 2,40,000 over here. Same on 2,40,000, we have calculated the value of depreciation. This 2,40,000 came over here. 2,40,000 minus 24,000 is 2,16,000. 2,16,000, and this is by balance. By balance carried down. This is the closing balance. By balance carried down. Let us move ahead. This figure, that is 2,16,000, will become opening figure over here. The date would be 1st of April 2016. To balance brought down, to balance brought down 2,16,000. I believe you understood. Now on the same year, let us see in the question, we had purchased the machinery. Another local machinery costing 80,000 was purchased on 1st April 2016. So we have purchased a machinery over here of 80,000, the same date. So we will write to bank account purchase of machinery, to bank account purchase of machinery. This is machine 2. This is machine 2. I hope you understand this. Now we need to calculate the depreciation on it on the last day, 31st March 2017. We need to calculate depreciation. So we will write by depreciation on machine 1 and on machine 2 separately, on machine 1 and on machine 2 separately. So on machine 1 the value is 2,16,000 till now. We need to calculate depreciation, so kindly calculate depreciation on machine 1, but this is of original cost method. The original cost is 2,40,000 multiplied by 20%. 2,40,000 multiplied by 20%, this is 48,000. I repeat, 2,40,000 multiplied by 20% into 12 by 12 is 48,000, and this 80,000 multiplied by 20%. 80,000 multiplied, do it on your calculator, multiplied by 20%. 80,000 multiplied by 20% is 16,000. So the depreciation over here is 16,000. 16,000. Now we need to calculate the closing balances. For the calculation of closing balances, we'll stretch these lines a bit. And write over here by balance carried down. By balance carried down, the date would be same, 31st of March 2017. So 2,16,000 minus 48,000. 2,16,000 minus 48,000 is 1,68,000. 1,68,000. This is of machine 1. Now we will calculate for machine 2. Machine 1 is done, 1,68,000. We will calculate for machine 2. 80,000 minus 16,000. 80,000 minus 16,000 is 64,000. Is 64,000. I believe you understood. Let's make a total. The total is 2,96,000 over here, and over here 2,96,000. I believe it is fair. It is fairly done. Let us move ahead. The third year, stretch these lines and we'll be doing the accounting for the third year. We will be doing the accounting for third year. We'll be doing the accounting for third year. So 1st of April 2017, 1st of April 2017, the opening balance. So two balance brought down, machine 1 and machine 2. So this is machine 1 and this is machine 2. Machine 1 is 1,68,000. Machine 2 is 64,000. We have also purchased a machine in this year. We have also purchased a machine. Another machine was purchased to replace the same for 40,000 and the date of purchase of machine is 1st October 2017. 1st October 2017 we have purchased a third machine. So 1st October 2017 we have purchased a third machine. Just write over here to bank account, third machine purchased, that is machine 3. Machine 3, the value of machine is 40,000. The value of machine is 40,000. 1,68,000 plus 64,000 plus 40,000. The total is 1,68,000 plus 64,000 plus 40,000. The total is 2,72,000. We need to calculate depreciation on it. We need to calculate depreciation on it. So we have purchased a machine, but we have also sold a machine for 27,840. So on 1st October 2017, a portion of the imported machinery value one third total machinery. So 2,40,000 was the imported machinery. One third of that machinery. Do it on your calculator. 2,40,000. Type 2,40,000 on your calculator. Multiplied by 1 by 3. Multiplied by 1 by 3. That is 80,000. Do it on your calculators. 2,40,000 multiplied by 1 by 3 equals 80,000. Now the rate of depreciation over here is on this machinery. The rate of depreciation is 20%. So just write on your calculator once again. 2,40,000 2,40,000 multiplied by 1 by 3, 80,000 multiplied by 20% depreciation, 20%, so it is 16,000. Now we need to calculate. So this transaction is happening on 1st of October 2017. So from 1st of April 2017 to 1st of October 2017, 6 months are there. So multiplied by 6 divided by 12. The answer is 8,000 is the value of depreciation. The answer is 8,000 and that is the value of depreciation. So just write over here 1st of October 2017 by depreciation. By depreciation. By depreciation. How we are calculating? 2,40,000 multiplied by 1 by 3. It is given in the question. Multiplied by 20%. Multiplied by 6 by 12. So over here the answer is 8,000. So this is on machinery sold. The machinery that we have sold, this depreciation relates to that machinery. Okay, we have sold the machinery for 27,840. So by bank account 27,840. By bank account 27,840, as you can see over here. So 27,840. What is the profit and loss? We need to calculate the profit and loss for this machinery. For this we need to make a working note. So just leave some line and come over here and write working note. Working note. working note, calculation of, calculation of, calculation of profit or loss on sale of machinery, on sale of machinery, calculation of profit or loss on sale of machinery. My dear students, just try and understand. 2,40,000, write on your calculator 2,40,000 divided by 3, divide by 3, that is multiplied by 1 by 3 equals to 80,000. This is the original cost of the machinery that we have sold. So write over here original cost, original cost of machinery is, original cost of machinery 2,40,000 multiplied by 1 by 3. One third is sold, that is 80,000 value of machinery is sold. We need to calculate depreciation on it. So less depreciation for 2 years, depreciation for 2 years from date of purchase, from date of purchase to date of sale, to date of sale. For 2 years, we need to calculate depreciation at the rate 20%. So 16,000 plus 16,000 is 30,000, 32,000. So 80,000 is the value of machinery into 20% on your calculator. 16,000 for 2 years multiplied by 2. So this is 32,000. This is 32,000. I'll show you over here the calculation. 80,000 multiplied by 20% is 16,000 multiplied by 2 years. Multiplied by 2 years, or 24 by 12. 24 months by 12 months. That is 2 years. So the total is 32. I believe you understood till over here. I believe you understood till over here. Let us continue. So original cost less depreciation for 2 years. So 80,000 minus 32,000 is 48,000. This 48,000 is book value. This 48,000 is book value as on date of sale. Book value as on date of sale is 48,000. Book value as on date of sale is 48,000. Less sales proceed. Less sales proceeds. Sales proceeds, we sold this machinery for 27,840. So we made a loss of 20,160. This is the loss. So right over here, loss on sale of machinery. Loss on sale of machinery 20,160. This loss of sale of machinery 20,160 needs to be accounted for, needs to be accounted for. Come in the question, just write over here in the table, write over here profit and loss, by profit and loss, by profit and loss account, that is loss on sale of machinery, loss on sale of machinery. What is the loss? The loss is 20,160. The loss is 20,160. Just stretch these lines a bit, stretch these lines a bit, stretch these lines, stretch these lines. 20,160. Now calculate the depreciation on rest of the machines. So just write 31st of March 2018 by depreciation. By depreciation on the remaining machines. So by depreciation on the remaining machines. So calculate depreciation on machine 1 first using straight line value method. So the total is 2,40,000, and on that we have to calculate the depreciation. So How we'll calculate that? So the total value of machine is 2,40,000. One third is already sold, so two third is pending, multiplied by 20% for the whole year, 12 by 12, multiplied by 20% for the whole year, 12 by 12. So 2,40,000 multiplied by 2 by 3, two third is remaining, multiplied by 20%, 20% for the whole year, 12 by 12. So machine 1 the total is 32,000. The total is 32,000. Let's calculate on machine 2 now. Let's calculate on machine 2. So we have purchased machine 2 for 80,000 in year 2. Over here, as you can see, in year 2, in 2016, we have purchased this machinery for 80,000. So 80,000 multiplied by 20%. Do on your calculators. 80,000 multiplied by 12% multiplied by 12 by 12 for the whole year, that is 16,000. 80,000 multiplied by 20%, make it 20%. So 20 by 100 for the whole year, 12 by 12. This is 16,000 on machine 2. We also need to calculate depreciation for machine 3. We also need to calculate depreciation for machine 3. So we have purchased machine 3 in the year 2017 for 40,000. For 40,000 we have calculated on purchased, but that is on 1st October 2017. So 40,000 multiplied by 20%. 40,000 multiplied by 20% is 8,000, and for 6 months, so this would be 4,000. Why 6 months? Because 1st October 2017 to 31st of March 2018. I believe you understood. So just write over here machinery 3, machinery 3, the value is 4,000. Now how this 4,000 value came? So we have purchased it for 40,000 multiplied by 20%. This is 8,000, and this is 6 months, so 6 by 12. I believe you understood. Now we are going to calculate the closing figures, the closing balances. So let's do the total of this. 1,68,000 plus 64,000 plus 40,000. So the total is 2,72,000. Just do the total in the credit side also. 2 lakh 2,72,000. 2,72,000. Now deduct all these figures from 2,76,000, 72,000. So just make a total 8,000 plus 27,840 on your calculators. Make a total 8,000 plus 27,840 plus 20,160 plus 20,160 plus 32,000 plus 16,000 plus 4,000. The total is 1,08,000. The total is 1,08,000. So 2,72,000. 2,72,000 minus 1,08,000. The total is 1,64,000. Total is 1,64,000. So just write over here total 1,64,000. Now this total includes machine 1, machine 2, machine 3, all. So just write by balance carried down machine 1, machine 2 and machine 3. So we'll calculate individually machine 1, machine 2, machine 3. So machine 1, as you can see over here, it is 1,68,000. 1,68,000. As you can see, 1,68,000 minus 8,000 minus 27,840 minus 20,160, and the depreciation, further depreciation 32,000. So minus 32,000. The balance over here is 80,000. I repeat once again. The value of machine 1 is 1,68,000 minus 8,000 minus 27,840 minus 20,160 and minus 32,000 for depreciation. The remaining balance is 80,000. Let's come to machine 2 now. 64,000, 64,000 minus 16,000. Do it on your calculator. 64,000 minus 16,000. This is 48,000. This is 48,000. Let's do it for machine 3 now. So machine 3, 40,000 minus depreciation 4,000. So this would be 36,000. This would be 36,000. Now make a total of it. 80,000 plus 48,000 plus 36,000. The total is 1,64,000. The total is 1,64,000. I believe you understood this. I believe you understood. I believe you must have understood till here. Let us move ahead. Let us move ahead. We are shifting to another method, that is reducing balance method or diminishing balance method. Reducing balance method or diminishing balance method. Let's try to learn this method, reducing balance method or diminishing balance method. Under this system, a fixed percentage of diminishing value of the asset is written off each year so as to reduce the asset to its residual value. So under diminishing balance method, the percentage is fixed, say 10%, but the amount will differ. The percentage is fixed, but the amount will differ. Repairs and small renewals are charged to revenue. We have already learned this. This method is commonly used for plant, plant, fixtures, etc. Under this method, the annual charge of depreciation decreases from year to year. The annual charge of depreciation decreases from year to year. That is, annual amount of depreciation decreases year to year, so that the earlier year suffers to the benefit of the later years. Also, under this method, the value of asset can never be completely extinguished because there would be some value which remains, which happens in the earlier explained straight line method, because the percentage was same in straight line method, and that is equal installment method, fixed installment method, and that is why the full amount is written off. But over here, the minor or nominal amount would be always there. However, it is very simple to operate. The method is based on the assumption that the cost of repairs will increase as the asset gets old. This is the assumption of that. The assumption is that the cost of repairs will increase as the asset gets old, and therefore the depreciation in the earlier years should be high when the repair cost is expected to be low, and the depreciation in the later years will be low when the repair cost is expected to be high. I believe you understood till here. Therefore, this method will result in an almost equal burden in all the years of the use of the asset, as depreciation will reduce with increase in the repairs and will increase with every passing year. On the other hand, on the other hand, under straight line method, the charge of depreciation is constant while repairs tend to increase with the life of the asset. Among the disadvantage of this method is the danger that too low a percentage may be adopted as depreciation, with the result that over the life of the asset the full depreciation may not be provided. Also, if asset is grouped in such a way that individual assets are difficult to identify, the residue of an account may lie in the asset account even after the asset has been scrapped. The last mentioned difficulty could be, however, overcome if the plant register is maintained properly in the business. If the plant register is maintained properly in the business, let us see the formula for calculating the WDV. So this is 1 minus n under root residual value divided by the cost of the asset. 1 minus n under root, that is number of years, residual value divided by the cost of the asset multiplied by 100. N is the useful life. N denotes useful life over here in number of years. So similarly, the straight line method, in this method also the period of use of the particular year of the purchase or sale an item of the property, plant and equipment needs to be considered while computing the depreciation account. I believe you understood till here. Let us continue and learn the accounting entries under straight line and reducing balance method. Under straight line and reducing balance method. So there are two alternative approaches of recording accounting entries for the depreciation. First alternative, a provision for depreciation account is opened to accumulate the balance of depreciation and assets are carried at historical cost. A provision of depreciation account is maintained to accumulated balance. The balance of depreciation and the assets are carried at historical cost. Just see the accounting entry. Depreciation account debit, nominal account. Depreciation is a nominal account. So depreciation account debit to provision for depreciation account. And at the end of the year, this depreciation account would be cancelled by transferring it to profit and loss account, will be closed by transferring it to profit and loss account. So the next entry will be profit and loss account debit to depreciation account, profit or loss account debit to depreciation account. Please understand the first alternative. A provision for depreciation account is opened to accumulate the balance, to total the balance of depreciation, and the assets are carried at historical cost. Accounting entry. So depreciation account debit to provision for depreciation account and profit and loss account to depreciation account. I believe you understood. I believe you understood. Let us see the second alternative now. Let's see the second alternative that talks about amount of depreciation is credited to asset. Amount of depreciation is credited to asset account every year. That means decrease in the value of asset every year. Decrease in the value of asset. In the value of asset every year. Every year. And asset account is carried at historical cost less depreciation, and asset account is carried at historical cost less depreciation. So the accounting entry will go like this: depreciation account debit as it is a nominal account to asset account, depreciation account debit to asset account, and the next entry will be profit and loss account to depreciation account. So this depreciation will be transferred to profit and loss account, as over here it is also transferred to profit and loss account. The first entry will be maintaining in the first accounting entry, the first alternative, we are maintaining the provision for depreciation account. We are maintaining the provision for depreciation account for accumulated balances to accumulate the balances of depreciation to total the balances of depreciation. And in the second alternative, the depreciation account, in the second alternative, the value of asset is reduced and the value of asset is shown at cost minus depreciation, historical cost minus depreciation. So this would be depreciation account debit to asset account and profit and loss account to the depreciation account. I believe you understood this. I believe you understood this. Okay, so I believe you must have understood this formula. This formula to calculate the depreciation rate, that is 1 minus residual value, scrap value divided by original cost of the asset multiplied by 100 is the useful life. Now let us do some example. Just try to solve few examples. Depreciation rate Just try to solve some examples. Just write example over here. Example. Let us write an example. Original cost. Original cost. Original cost is 1 lakh. Original cost is 1 lakh. Write scrap value, the residual value. So scrap value is 20,000. Scrap value is 20,000. Life is given expected life, that is 4 years. Life is 4 years. Life is 4 years. We'll write the solution. We'll try to solve it. We will try to solve it. So this formula, first write the formula of depreciation. So WDV depreciation rate. WDV depreciation rate is also written as 1 minus residual value, 1 minus residual value, that is scrap value, divided by original cost, divided by original cost, and this whole is divided by 1 by life of the asset. 1 by life of the asset. So we will calculate what? The depreciation rate. And for calculation of WDV depreciation amount, we need to multiply it by the rate. Okay. So let us continue and try to solve it. Write over here WDV amount, written down value amount equals whatever WDV we will calculate, and will WDV multiplied by WDV depreciation rate. WDV depreciation rate. So first we will calculate over here WDV depreciation rate. We will calculate WDV depreciation rate over here. So 1 minus 20,000 divided by 1 lakh, and the life is 4 years, so 1 by 4. You see it over here, 20,000 divided by 1 lakh. 20,000 is scrap value divided by 1 lakh, and 1 by 4 is the life. Life is 4 years, so 1 by 4. So first you try to solve this figure. First you will try to solve this figure. So on your calculators, all of you, type 20,000 divided by 1 lakh. Type 20,000 divided by 1 lakh. So on your calculator, type 20,000 divided by 1 lakh. 0.2 must have come on your calculators. Type 20,000 divided by 1 lakh. 0.2 must have come. Now you should understand that over here this like 1 by 4. So there is a root on your calculators, root x. So if you press that root, that will give you 1 by 2 figure, 50%, 1 by 2. So press 2 times root, will receive what? 1 by 4. So 0.2 is there on your calculators right now. Just press 2 time roots. Root and root. Press 2 time root. You have pressed 2 time roots. After that, the figure on your calculator is 0.6687. The figure on your calculator is 0.6687. So just write 1 minus 0.6687. If you minus it, you will receive 0.3312. 0.3312 for, so this is the amount you have received. For calculation, the rate we have to multiply it by 100. 33.12%. So this is 33.12% because we have multiplied by 100. We have multiplied by 100. We have multiplied this by 100. So we have received 33.12%. 33.12%. I believe it is clear. Let me write the steps to calculate this over here. working working on calculator. Working on calculator, what you will do first you will type step 1 20,000 divided by 1 lakh. On your calculator you will get the figure 20,000 divided by 1 lakh 0.2. On your calculators you must have received 0.2. Now step 2 we have to do 1 by 4 25%, so we have to press 2 times root. Press root 2 times on calculator. Press root 2 times on calculator. So after pressing 2 times root you will receive the figure 0.2. Press 2 times root. The figure you receive is 0.6687 something something, 0.6687 something something. Step 3 1 minus 0.6687. Step 4, now there's nothing needs to be done, so this is 0.3312. 0.3312. Now this 0.3312 multiplied by 100, so that is 33.12%. I believe you understood. So on calculator, this much only you need to do on your calculator. This much. This is simple. So this was the thing. I want to share few things with you. Supposingly, you the life is 2 years, you have to do 1 by 2. So on your calculator, press 1 time root. That will give you 1 by 2. If it is 1 by 4, then you have to press 2 times root on your calculator. This will give you 1 by 4. I repeat, if you have to calculate 1 by 2, press 1 time root. If you have to calculate 1 by 4, that will give you 2 times root. If you have to calculate 1 by 8, then you have to calculate 3 times root. 1 by 16, so 4 times root, and like this we can move ahead. I believe you understood. This. Yes. Let us write one more example and try and understand. Let us take a difficult figure now. Let us take a bit difficult figure. Right example. Original cost. Right example. Original cost is 1 lakh. Original cost is 1 lakh. Scrap value is 20,000. And estimated life estimated life is 7 years. So original cost is 1 lakh, scrap value is 20,000, and estimated life is 7 years. We need to calculate WDV. Let us do the solution now. Try to solve by your own. Try to solve this by your own. First, we need to calculate what? WDV, depreciation rate, written down value, WDV depreciation rate. This needs to be solved. So 1 minus 20,000 is the scrap value. Original cost is 1 lakh and 7 years is the life. So 1 by 7, and at last we'll do multiplied by 100. So 1 by 7. I believe you must have understood. So we have to calculate 1 minus this figure. This figure needs to be calculated. So on your calculator, so if you solve this on your calculator, you'll get the figure 0.7946. So 1 minus 0.7946 is 0.2054 multiplied by 100, that will give you the figure 20.54%. 20.54%. I believe you understood this. I believe you understood. So what we have learnt in today's class, what we have learnt in today's class. So we have seen a long sum in which the machinery accounts needs to be prepared using the SLM method. We have done this long sum. In this question, we have prepared a machinery account, that is truck account. Truck account. So basically, there was two trucks, one old truck and one new truck. So we have sold a few portion of the old truck also in between, and accordingly the gain or loss is accounted. Then we have seen a very long sum in relation to machinery account. There was three machineries involved: machine 1, machine 2 and machine 3. All the three machineries is purchased on three different years. So first year we have purchased the machinery, depreciated. On the second year we have depreciated the first machinery, we have purchased the second machinery, and we have also depreciated the second machinery. In the third year we have purchased the third machinery. So in the third year we have three machines: machine 1, machine 2, machine 3. Out of that, the first machinery is depreciated, second machinery is depreciated, and third machinery also depreciated. And along with that, the depreciation of the machinery we have also done. We have sold it and recorded the purchase and sale is recorded. And after that we shifted to reducing balance method, that is WDV. We have learned its accounting, and after that we have concluded this. Fine. So we wind up till here. We end here. Thank you.